Well, at the moment, actually, we're pretty sanguine overall. I mean, last week, the Russell 2000, which is the US sort of version of the small cap index, hit record highs, which sort of goes to show that the market rally in the US is somewhat broader than just the FANG stocks, like, you know, the Facebooks, the Googles, the Amazons. So that gives us confidence. Also, what gives us confidence is that although interest rates offshore in the US are rising, they're not going to be going at a kind of a clip that's too fast for the market to absorb, in our view. You know, the Fed's inflation target wasn't met, 2% inflation target wasn't met. So I guess, you know, over here, interest rates aren't going anywhere anytime soon, in our view, because I guess the you know, the individual's debt is very, very high. So people have a lot of debt, and that means that the Reserve Bank's going to be very nervous about raising interest rates. There's always risks out there, you know, what they call exogenous risks, or risks that can't be foreseen. I mean, on the Korean Peninsula, we're seeing tensions rise. We're seeing, you know, under Trump, there's the ever-present risk of a trade war. You know, even the Spanish situation, the Catalan independence has flared up. So there's always going to be risks. And I think if the market is hit, it's going to be from one of these risks, not necessarily, not interest rate risks. We're small cap specialists, so we focus on stocks that we think can grow quickly, that provide good return on equity, that can grow quickly and are very cheap. And we think that those sort of stocks will outperform irrespective of what the market does. Big caps analysis tends to focus more on the macro picture, because that's where they add value. That's much harder to predict. We specialise in meeting with management and going through the financials, you know, in a forensic nature, and really coming to grips with the IP of different companies and working out, you know, where there are gaps in what the market knows and what we can find out. Recently, we've made a lot of money, something like 30% from Kogan.com, off the back of some analysis we did of the telephony deflation. They're big beneficiaries of, you know, reducing telecom prices as a reseller of Vodafone. So that's one example, and it also is an example of where the market just sort of didn't really look at the underlying fundamentals of the story, or really understand the story. And I think it also shows that retail isn't dead. It's not going to be killed by Amazon, and there are profits to be made. Another example is the Reject Shop, where we made a relatively quick sort of 15 or 20% profit on that with a change in management strategy. It's somewhat of a turnaround. There are lots of risks there in cyclical stocks, which means that, you know, economic conditions play a big role in their earnings. So that's why you need to be, you know, reading our report closely to see not only when we buy the stock, but when we, you know, take profits. Technology stocks are an area where Under the Radar can really add value, because I guess there's a lot of uncertainty in technology and there's a lot of operational leverage. So for fixed costs that are limited, these companies can really achieve revenue growth, and, you know, those profits drop to the bottom line. Like Nanosonics is one that was oversold and we jumped on board. LBT is a stock that we backed, and they're in robotics. Certainly, you know, stocks that you probably haven't heard of, but you know, they're small, so any sort of increases in revenue are greeted by the market, because it's such a changing marketplace, and people are looking at robotics to really increase their profitability. Well, I think Billabong's definitely a turnaround story. Like, we've seen the stock bounce. The good thing about Billabong is you're not paying much for it. So any benefit that you see from the margins and from the sales line will really translate to, you know, big profit growth. So I guess we're looking at a situation that does have a powerful brand, but they have seen some corporate missteps mean that, you know, it's certainly one of the more high-profile implosions on the corporate scene in Australia. And that's what we try and take advantage of when we see a company that we think still has a strong brand. So it's got a relatively big footprint in the retail world, but you know, you're not paying much for that. There's different growth opportunities in sectors like batteries, where, you know, there's a lot of hype around batteries, but they need that technology from lithium and graphite. So we're going to be looking at that. We are, as I said, turnaround specialists. So we are looking at this week at a turnaround, which I guess has been written off by many people, but you know, their last results showed a lot of reason for hope, and that it's trading around net asset backing. So there's a lot of potential to make some good money there. You know, they get some solar contracts and they get some wind energy contracts. You know, they'll be back in the game. Definitely, when it comes to growth, that's our focus, but it's also growing dividends. We're looking for companies that are going to, I guess, produce not only earnings growth but dividend growth, and also for companies where the market's kind of anticipating that they're not going to maintain their dividends. So like companies like Cabcharge traded at 10%, 11% yield. That indicates that the market's wary of their ability to maintain those dividends. So our analyst team does a lot of research on those companies, and we speak to the management and we go behind their financials. You know, where we think it's maintainable, we step in, because you can double your money in a number of years based on the dividend yield alone.